Hi, I'm Sumit Poddar from Tikona Capital, CIO at Tikona Capital. I'll take you through the market outlook as far as December 2023 is concerned. In our last video, we discussed about how we are looking at the markets, and we could share with our investors uh, the updates in the market, as well as our view was on track as far as hitting new highs. Right, coming to Tikona Capital, it's a SEBI registered investment advisory business as well as SEBI registered research analyst. We here the thought process is to invest in high quality businesses to build long term wealth. So standard disclosures and disclaimer about our firm. Whatever we say on this presentation or video would largely be on educational purpose only, and you need to consult your investment advisor to take any investment decisions. And similarly, investment securities are subject to market risk, and you have to read all the related documents carefully before investing. So these are standard disclosures, as I mentioned. Coming to what are views on equity markets. Yes, this is what is happening. Nifty is scaling new heights, uh, primarily supported by the economic reforms. They are continuing. We saw a fantastic outcome as far as last three state elections are concerned, and it was also supported by kind of lightening effects of interest rates and global growth rate, which was about to slow down, which is why we saw a bit of a correction during October November period. But I mean, we are seeing it coming back in the past few um, weeks per se. So taking a bit yearly view, if you look at the year, we have seen Nasdaq and Nikkei outperforming the global markets, primarily because of US surprising the world with the strong GDP growth rate. Despite the expectations of recession, we are seeing US GDP growth rate surprising on the upside, which is why we have seen Nasdaq coming back with a strong 26% growth in this particular year. Nonetheless, looking at how things have been on the last 1 month, Nifty continues, or Nifty has been on the top performing markets within Nifty, Russell 2000, and to some extent DAX. Right, all these outperformance Nifty is primarily because of the range bound interest rate, or maybe the interest rates in India, which continues to be well controlled, well within the targets, which is further adding to the stability in the markets. Nonetheless, we will discuss about prominent economy is looking in a very sweet spot in the upcoming slides. Uh, as compared to the globe, of course, last 1 month we have outperformed, and it's not just 1 month. Even post COVID, we are one of the best performing markets globally. But coming home, if you look at the sectors, reality, PSU, and autos are the one which have outperformed quite well in the last 1 year, and within that, mid cap and small caps continue to outperform. The point to note out here is largely on the SME IPOs. They have delivered stupendous 110% returns in the last 1 year, and they are up 3x. Let me repeat, 3x in the last 3 years. Now, let's delve into what really is happening in the economy and what is driving the markets. Last 2 to 3 years, or maybe at least post-COVID impact on inflation was huge. I mean, if you look at 2022, we had seen inflation kind of going through the roof, and especially the developed world had touched almost 10% kind of number. Now, incrementally, what's happening is we are seeing that inflation is surprising on the downside. If the expectations are 3.5, they're coming out 3.2. Similarly, I mean, every other reading is lower than the past reading, as well as lower than the expectations. So India is kind of comparatively less volatile if you look at the Indian inflation, and while it is less volatile, also Indians have seen a very high inflation rates. I mean, 5, 10, 15 years back in our lives as well. So if we kind of broadly look at the economic scenario, global economic scenario, we see is quite resilient or better than what was expected in the first half, and that is why we see 2023 growth rates would be much better than expected, as well as it is expected to grow at 3% and slow in 2024 at 2.7%. Headline inflation continues to decline. We've already seen US yields moving down by 75 basis points since the recent peak, and despite the events that have taken place in terms of geopolitical issues, in terms of supply being kind of protected, we have seen oil behaving quite in a protected manner. Sharper slowdown in China, especially because of the fact that the property market is not doing that great. The government's focus is a bit lesser on growth, and any event that would take place in China would be further drag on the global growth. The biggest worry as far as the globe is concerned remains public debt at an elevated level, which is what is the watch point on the global economy. So having said that, what is the outlook? I mean, going forward, yes, US is expected to slow down, and inflation is continuing to ease on back of tighter monetary policy. So the main moot point comes down to whether US Fed is likely to cut the rates in 2024, and which is what is driving the expectations and putting pressure on the 10-year yields. Growth is slowing nonetheless, but the heartening part is the lower inflation, and even the interest rate hikes are well in control, and which is what could put the lid on the incremental risks part. If you look at the domestic scenario, of course, post win of elections, state elections, the political reforms, or rather economic reforms, are likely to continue. Broader market sentiments remain positive. We have seen the IPOs, the liquidity that is kind of flowing in domestic market is phenomenal. If you look at the corporate results, they were in line and was supporting the equity markets. GDP growth rate was well above the expectations, and which is what is likely to lead the upgrades as far as the full year numbers are concerned. So despite hitting new highs, valuations and momentum are quite supportive as far as the Indian equity markets are concerned. So coming to the economy part, yes, GDP growth rates for India continues to be strong. So we are just dwelling on specific points why we believe India continues to be on the strong footing. So GDP growth rate is one of the topmost as far as the major economies are concerned, while the world is kind of slowing, but we could see India GDP growth rate to be of top-notch delivery. Inflation, as we discussed, so look at the inflation. I mean, 9.5%, 10% to almost 10% to less than 4%. Nonetheless, it remains above the threshold which Fed would like to see. But nonetheless, this gives a path for US inflation to correct and go down. Interest rates are well within the Fed fund target, and the moot question, as I said, whether a cut in 2024 or not. Treasury yields in past month itself have kind of corrected almost 75 basis points, a strong 75 basis points, which gives a comfort to the risk assets like equity markets globally, right? So that's a very heartening part per se. Even in Eurozone, inflation continues to fall every month, and it is like right from peak of 10.6% to 2.4% in November. I mean, the rate of fall in inflation continues to be a very rapid fall, and which is what is extremely heartening to see. However, the inflation or maybe oil prices are on watch by the global central bankers, especially to see if they don't take actions ahead of the curve. Coming to Indian markets, a strong manufacturing or industrial growth with electricity, basic goods, infrastructure driving healthy growth. If you look at the summary, consumer sentiments are strong in October. FII selling, I mean, despite the selling in the last 18 months, we've seen it is getting absorbed by the domestic players. There are mixed trends as far as rural spending is concerned. Agri credit continues to be strong at 16% growth, while the rate GDP growth rate is at 6% plus, and given the surprise, we would see that it is likely to get upgraded. So overall, a healthy mix with investments on a strong footing. Consumer sentiments are kind of strong, with balancing factors of rural spendings seeing mixed trends. So it's a mix where some parts of the economy are kind of thriving, with mining, capital goods or infra, primarily because of the capital spendings by government, and at the same time there are counter balancing factors, which is a healthy mix, because sometimes some part of the economy will do well, sometimes some other part of the economy will do well, and it creates that virtuous cycle. Inflation, as we discussed, is in quite a healthy range of the central banker. As we said, growth has been on the fantastic footing, primarily supported by manufacturing and sustained expansion of IIP. We discussed this, yields are kind of falling in line with the global markets. Indian yields are kind of down by almost 25 basis points in the last 1 month. The risk premium is quite getting attractive if we compare or rather the risk premium is getting squeezed, and overall India continues to be in a strong footing and creating another anti-fragile movement where India behaves a bit differently than what is being expected. We have always surprised, especially after COVID. India has always surprised on the positive side. All the weaknesses have actually become our strengths, rather it be on the health side or on the crude side, and now on the interest rate side. I think we are on a very strong footing. A heat map as far as the Indian economic indicators are concerned, they continues to be on positive trajectory side, whether it be bank credit growth, vehicle registration, UPI payments, credit cards, FPI debt continues to be strong, DII flows continues to be strong. So broadly, if we put at the economy side, yes, it is likely to reach almost $7 to $8 trillion by 2030. We are likely to exceed Japanese economy by 2030. This is largely supported by growing middle class with consumer spending in place. India is becoming a destination where the globe cannot really ignore as a country, as a business, where they don't have their investments. So we expect that FDI flows will further support the economy, and we are, nonetheless, I have continuously repeated this, we are one of the fastest growing economies, which everybody is aware, but that is what is likely to support markets, that is what is likely to expand GDP per capita, and which is what in turn will help the Indian equity markets. Markets have seen quite a good strength, touching new highs, despite FIIs continuously selling. Rather, FIIs AUM as a percentage of India market cap has seen one of the lowest holdings since a long time as such. And so coming to the corporate earnings, let's take each of the sectors. Autos continues to be on strong footing, with higher selling prices, good sales volume, and which is what is leading to a good operating leverage. So they have delivered a very healthy results in this particular quarter, and even going forward, it remains in a positive or a very healthy zone. On the BFSI side, we have seen good loan growth or disbursement growth as well. Even the asset quality is on a fairly good side. There is a sequential decline as far as the profitability or net interest margins are concerned, but that's not a large worry given the fact that the asset quality is in place, the loan growth is quite healthy. Given the current scenario, we expect, or rather, with the valuations in our favor, it is kind of creating a good opportunity in the market. Capital goods order books are flowing in with the capex recovery as well as the recovery in the economy. We could see healthy order flows going forward. The past has been supported by the government capex. Maybe in the future, it's all about the private capex coming back. So with this, we are also seeing cement consumption on the rise. We have seen revenues declining, but the margins have got impacted because of some of those shutdowns, right? So the demand remains kind of robust in the market on the cement and construction materials side. Technology got impacted because of the global sentiments. Clients have spent or they have indicated of lesser spendings. Nonetheless, the order books continue to flow in. Order wins are there in place, and the valuations have come to comfortable zone. But nonetheless, we have to keep a watch on how the new technology transition or transformation, especially with AI coming in, is in place. The technology is getting complex. That will give much more opportunities, but how client spendings really come out is going to be the driving factor. Specialty chemicals, very weak results as far as this quarter is concerned, which was relatively known. There is pricing pressure, and which is what is impacting the margins. The commentaries are suggesting 2 to 4 quarters down the line, there is likely to be stabilization and demand coming back. Valuations have corrected quite a bit. A patient investor definitely can look at this sector in a positive manner. Consumption and retail, we saw rural markets impacting by food inflation and erratic monsoon, but and even commodity price inflation impacted the profitability, or rather it was healthy in this particular quarter. But yes, this despite the earnings being in line, I think this sector is on a watch. So net what we are seeing is BFSI has delivered healthy growth. Similarly, auto anchors have given good growth, which is what is supporting the overall earnings per se. Nifty premium over emerging markets continues to be at more than 50%, but this is not really very absurd, right? So they are near kind of averages, which is why we don't feel that the markets are kind of overheated despite it hitting new highs. Likewise, the price to earnings multiple, they are just at 5% premium. Of course, with the current run up, they are not too far from the averages, and they are not kind of in an exorbitant area to really get worried about. I mean, whenever in the past, whenever any markets have gone into bubble areas, they have been trading at 25, 30, 40 kind of a P, whereas in the current scenario, we are somewhere around 18 to 20 P multiples, which is what at least says that we are not in the bubble area. We and earnings growth is kind of supportive, and with further economic reforms, they are likely to be supportive. Even on the small cap, mid cap side, especially from an index level perspective, they are not in exorbitant valuation. Of course, one may say that if the earnings fall, possibly these valuations would also look very expensive, but that doesn't seem to be the case as of now. So GDP, as we said, on strong footing. Geopolitical issues have not really played any kind of spoil sport. Worries have subsided on the election side, and liquidity continues to be on a strong speed. So to really sum up, one must look at rotating sectors, to sectors like banking, MFIs, to some extent PSUs, which continues to be in a value zone, manufacturing, and one needs to balance the portfolio with a few sectors which have already borne the brunt of high expectations. They have come to zone where valuations are not as high as in the past. If there is an improvement in the global economy, possibly these stocks or these sectors can come back, especially on the IT and chemical side. But nonetheless, we are much more positive on banking, MFI, PSU, and manufacturing per se. Having said that was a near-term outlook, I would say. I would like to take you through the major long-term Amrit Kal supportive argument as far as India is concerned. Amrit Kal for India is supported by young India, which is an educated class, entrepreneurial class, which is well equipped with the technology, English speaking class, digital India. I mean, we are seeing UPI, we are seeing platforms over platforms, and which is what is driving the mass customization as scaling in the country, as well as reducing the overlap or inefficiencies at every aspect in a daily life. And last but not least, which can really further drive the country, Startup India, Make in India, which is making every citizen of the country think in an enterprising mode, right? So these three areas are extremely supportive as far as Amrit Kal is concerned. Future mega trends continue to play a very major role on the growth side. I'll just these we have discussed in our past presentations on this. You may really refer to that, but the mega trends continue to be trending well or supportive to the Indian economy per se. Multi-decadal themes which will continue to succeed in the Amrit Kal, rather it be manufacturing theme or consumption or formalization or the renewable energy or the financialization or the technological disruption. So we'll have a snowball effect on the snowball effect and value migration with India stack in place, right? We've written a fantastic article on the journey to Nifty to 50,000 over next 8 to 10 years, and what are the kind of risks and what are the kind of mitigation strategies that can be deployed. There is further blog on our website which one can refer to. Having said that, let me conclude by saying that India has just, or the story has just begun. We are 3% of global economy as of now. Pre-1000 AD, we used to be 30% of the global economy. So we have a long leeway as far as growth is concerned. So this is going to be one of the greatest wealth creation opportunities in the equity markets for all of us. Please participate, stay healthy, stay invested. So if you want to follow, you can follow us on any of the channels. You can subscribe to our blogs where we share multiple nuggets of wisdom, and we would like to see you as our subscriber, as our followers, and share our knowledge with all of you. That's to conclude. Stay healthy, stay invested. We continue to be positive as far as the equity markets are concerned. Right.